Picture this, you're 83 years old, you need round-the-clock healthcare, and your nest egg, yeah, it's completely drained. It's the nightmare scenario for retirees everywhere. And it's what the 4% rule was invented to help prevent. This simple guideline quickly became retirement gospel, but it's faced its fair share of criticism, including from its creator. So we're going to stress test the 4% rule to see if it's up to snuff. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TDirect Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm really excited to bring you today's episode. We're challenging one of the pillars of retirement income planning in the 4% rule. Is it all it's cracked up to be, or should retirees adjust their thinking? We're going to crunch the numbers to find out. Plus, we're going to discuss some of the ways to squeeze out more out of your retirement nest egg later in the show. And of course, we're going to take your questions later on in the program in our Q&A session, so stick around for that. But for now, let's dive into our conversation. Joining us is Kyle Prevost. He is the founder of the DIY retirement investing course, 4 Steps to a Worry-Free Retirement. And you might also know him from his investing blog, Million Dollar Journey. Kyle and his wife reached financial independence at the ripe old age of 35, and now they spend much of their time living abroad. Kyle, wonderful to have you on the program. Really appreciate you taking the time.
Thanks for having me, Rob.
Yeah, I got to say, we're going to dive into the 4% rule here, but I want to dive into your personal story here a little bit because it's fascinating. You reached financial independence so early in life, and you did it on a teacher's salary. A lot of people don't accomplish that in their entire working lives. You did it so quickly here. How did you do it?
I wish I had. I don't know if I agree with the fascinating aspect of your description there, Rob. I wish there was sort of like some hot stock tips or some sort of proprietary way that I generated wealth. But honestly, it was a little bit of planning and a little bit of good luck. Basically, my wife and I met in university, so meeting your partner fairly young in life and then having sort of a 2-income household obviously helps a great deal in building wealth young. As well as growing up on the prairies, actually, just costs a lot less money, and also your attitudes about keeping up with the Joneses, so to speak, are fairly low standard compared to in major urban centers. There wasn't a lot of sports cars or comparison of Gucci bags or anything like that growing up. So I think those would probably be statistically the main things that got us where we are. And I would say like a couple quick hacks as I was able to develop sort of this side hustle of writing and speaking about personal finance on the side. And then when my wife and I started international teaching in the country of Qatar, it helped because there's no income tax and there's also no dividend taxes or capital gains tax. So your portfolio is essentially one big TFSA. So that obviously helped in recent times as well.
Yeah, certainly. I mean, I know you mentioned luck there, but you got to be good to be lucky, okay, Kyle? Like, you guys did a lot of good things with a lot of smart habits here, and of course, just one of the big ones being just consistently investing over time for the long term. So I'm curious, what does life look like for you guys now that you're financially independent?
Yeah, so after a few years of international teaching, we'd reached a figure where we were like, hey, we're pretty sure, if we keep the right asset allocation, we use the 4% rule, we'll probably never have to work again. Maybe we'll want to afford some luxuries or sort of increase lifestyle spending, but we don't have to. And so I'd been doing a lot of reading about the phrase digital nomad. This was coming out of COVID, and we were ready to kind of travel and see some more things outside of the Middle East. And so we did a year. We went to Portugal for 3 months. We did a couple months in northern Thailand, in Chiang Mai, a month in Japan, and a month in Bali. And somewhere in there, my wife decided that she just loved teaching so much. I call her one of these like super fortunate weirdos that just loves her job that would maybe do it if she didn't get paid at all, although I maybe wouldn't admit that to her employers. But she just is happier at work. And obviously, I can kind of do my online thing from anywhere these days. So yeah, we're in Asia for the time being and enjoying, I guess, the freedom of things.
Yeah, and it's on your terms, which is really like the big thing that everybody's really after here. I got to say that you guys, having reached financial independence so early and you're kind of working on your own terms here, a lot of retirees, they worry about running out of money, quickly, or not. They're not having enough throughout their entire retirement here. You guys are going to have a quote-unquote retirement that could be like 50 plus years. And particularly in the face of all the market volatility and uncertainty we're seeing here, what makes you confident that you're going to make it?
Yeah, so I guess there's kind of a couple aspects of that. One is you kind of mentioned in recent times we've been seeing so much market volatility. You know, the funny thing is, Rob, despite the news headlines, the last few years have actually been abnormally non-volatile, relatively speaking. Like when you think historically, when we're coming out of like world wars or like Cuban Missile Crisis, Great Depression, 1987, Black Monday, 2008 financial crisis. There's rarely a time where you'll ever turn on a news broadcast and hear them say like, now is the perfect time to be investing. And usually the few times that's happened, it's actually been historically some of the worst times. So that's just kind of an interesting big picture perspective on the matter. And I guess the other thing, and I think this is important when framing the 4% rule and deciding when to retire, is I feel like there's a lot of emphasis on longevity risk, which means that worst case scenario that you outlined, where we're looking at, I'm 90, 95, 100 years old, and I'm running out of money, and now what? And that is obviously a risk, and it is worth understanding, but I think there should be a little more attention paid to the risk at the other end of the spectrum. And that is like, I've had several family and friends, either right before they retire or in the 5 years post-retirement, whether it was develop a debilitating condition, whether it's pass away tragically, there's a real risk there as well. Like I find that a real tragedy to develop a debilitating disease the year after you retired, and that is maybe, in my opinion, for my specific risk assessment, that is actually something I'm more afraid of than running out of money at 95. So we're constantly trying to balance these two variables as we look at sort of historical metrics applied to a safe withdrawal rate.
Mm-hmm. Yeah, and we're going to talk a little bit more about the 4% rule here and looking at how it has performed in the past and why it might give you some confidence, at least if history is any guide here. We're going to get into that here. For those in our audience, though, if you want to get in on the conversation and send your questions to us, we'd love to have them. So if you're watching on Webbroker, you can use the chat box there to send your questions to us. If you're watching on our online broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, just click on the link in the description. It's going to take you over to the broadcast platform, and you can ask your questions there. Okay, Kyle, before we dig into the 4% rule, how it's performed and all that good stuff, let's just take a step back here. Can you explain what the 4% rule is, how it works at a high level?
Yeah, basically, prior to 1994 to the best of my knowledge, when the so-called rule was popularized by a man named Bill Bengen down in the States, a financial planner. And prior to that, when people said, hey, how much do I need to retire? We all said, depends. And then we would all fill in various it depends. And usually it boiled down to like, keep paying me a lot of money as your advisor to tell you when to retire. And Bengen looked at US specific data and he said, look, if you've got 60% of your money or 50% of your money in stocks and the remainder in bonds in the US market, I went back and I looked at every year, I looked at World War II, I looked at the Great Depression, you can spend 4% of that portfolio plus inflation each year, which is the part that confuses a lot of people. And you can do that for a 30-year retirement and you don't have to worry about running out of money. So it was kind of looked at as a conservative way to approach a safe withdrawal rate. In other words, how much can you withdraw and be very confident that you will not run out of money. So if you got $1 million portfolio, you can withdraw $40,000 the first year, and then up by inflation every year after that, and be reasonably confident was the thesis. And I would say the thesis has more or less held true.
Mm-hmm. And the other thing that goes hand in hand with 4% rule is this 25 times your annual spending expectation, right? If you can get that saved up and you can withdraw 4% of it each time, you have a good chance, at least if history again is any guide, of being okay. I'm curious, just for retirees who might not be familiar with 4% rule intimately here, are there certain limitations that they need to consider when they're thinking about it as they plan their retirement spending?
Yeah, obviously the 4% there that you mentioned, Rob, just to quickly explain, it's just the flip on math. I'm not a math major by any stretch, but like you just explained, if 4% is what you can safely spend, then 25 times 4, if you get 25 times that amount of money that you want to spend, then you're kind of good to go according to the 4% rule. Now, some of the limitations are, which is why I like to refer to it as the 4% plus inflation rule of thumb, because we know that people don't act in a perfect linear pattern, and there's also no allowance for like big fees or taxes in the 4% rule. So there's certain sort of real life variables that will come into play. But I think, what we have to balance when discussing something like the 4% rule of thumb is giving people a target to shoot for and feel reasonably confident about, especially if they're DIY investors, versus having people's eyes glaze over as you get really far into the weeds. And we're going to explain some of the variables today. But I think the key takeaway is, once you get past the OAS, the CPP, and you minimize fees as much as possible, this is already a very conservative approach. And so it is fairly safe over the long term.
Yeah, certainly it's more of like a guideline, a rough estimate, the 4% rule, than something that's really prescriptive, of course. One of the things, too, we were just showing up on screen there, this idea of sequence of returns risk, which is something that terrifies retirees, that they're going to have a bad sequence of stock market returns early in their retirement. It tanks the value of their portfolio, and now they have a lot less to live on the rest of the time here. That's certainly a risk, part of the nightmare scenario for a lot of retirees here. But the 4% rule is designed to kind of keep those kind of things in mind here. So, bottom line here, how has the 4% rule performed in the past? Do you think you can bank a retirement on it, generally speaking?
Yeah, I plan to. I advise my parents to plan to. And so I do think it is that safe. Just to give some idea, Rob, like Nick Majuli, who's a writer in the States, he wrote in 2023, and he said, across all wealth levels in the U.S., about 58% of retirees withdrew only the amount that their portfolio gained, and only 16% actually ever touched the principal at all. Just to give an idea, if you use the 4% rule, and we look at the historic backtesting using US-only data, which is, again, a bit of a limitation that we can address later on here if you want, we see that over half the time, you're going to pass away with double the amount of money you started with. 95% of the time, you're not going to even spend the original amount of money that you started with. So this is obviously very conservative. Now, you mentioned the sequence of returns risk. That is, statistically speaking, the biggest risk, where we look at, we can say over 40 years, we had an 8% return in the stock market. But depending on if you had a lot of good years at the beginning or if you had a lot of bad years at the beginning, that can make a radical difference to not just your end result, but how stressful or stress-free your spending was along the way. So the 4% rule is meant to, hold up confidence in the face of some pretty stressful early sequence of returns events.
Yeah, and I think one of the things that people need to understand about 4% rule is that the 4% is it's like the lower bound threshold of like what you could get away with, right? Most of the time, the withdrawal rate has been quite higher, and to your point, you'd end up with like double the amount of money over a 30-year retirement. On average here. Like that's a pretty compelling situation to be in here. So if anything, we can kind of look at the 4% rule and kind of say, it might be conservative in most cases, but what about those, nightmare scenarios where like there's some like huge market event or something like that? Does the 4% rule still kind of hold up when something like that happens?
So, historically, when Bengen looked at the data, the 4% rule held up during the Great Depression. It held up over those very high inflation years. To give another example, if folks had retired in 2000, right before both of those dot-com crashes in 2000, 2002, you can look at a pretty rough retirement. That would be a lot of people's modern worst case scenario, we'll say. And so they would have went through a stock market crash 2 out of their first 3 years. And then they would have went through, the financial crisis in 2008. And then they would have went through COVID. And now maybe they're hearing headlines about tariffs and a bunch of other things, Brexit and all the other debt crises in between. And they would still have just as much money today if they were invested in a 60-40 portfolio as when they started in 2000, assuming it was invested in global stocks. If you were just in U.S. stocks, you'd actually be quite far ahead of that, just as a comparison point. So yeah, I think it's pretty darn safe. I know there's some folks out there that have said, look, it's unrealistic to expect the same returns going forward as we've just seen the last 100 years. And it is a valid criticism of the 4% rule to say, look, Bill Bengen was only looking at U.S. data. There's a lot of us that don't live in the U.S. We don't invest exclusively in the USA. So what about us? And Wade Pfau did some interesting work. And actually, Canada was the only country that had a slightly higher safe withdrawal rate historically than the US. Now, the US had a higher average return rate, but in other words, Canada's worst stretches were not as hard as the US's worst stretches over the last 100 years or so. Now, if you start bringing into the conversation, for example, I know Ben Felix of PWL has done some really great work on this. We agree on a lot of things. But Ben has kind of popularized the 2.7% rule based off of some international data, some international studies of the last couple of years. And I think that's a little bit needlessly pessimistic. And I think it gives the wrong message to a lot of people. And where that data comes from is looking at developed economies other than the US over the last 100 years. But I take some exception to the idea of like adding in pre and post-war Germany, Russia, Italy, Japan. Like, yes, if you have an atomic bomb dropped on your country, that's going to affect your stock market, clearly. I would argue that in today's world, if you were to buy a globally diversified portfolio that's roughly, these days it would be roughly 70% American, even if it's 70% combined American and Canadian, the chances that you're going to see a nuclear war, I would argue, are infinitesimally small. And if it does happen, I don't think you're going to be worried about your portfolio, truthfully. So I think that 2.7% is needlessly pessimistic. And yeah, I would argue it's not a good balance of the probabilities that we started with discussing in terms of risk on the front end and the back end of retirement.
Mm-hmm. Yeah, it's certainly like, a lot of people will also argue that the market today is quite expensive, and that might affect the forward returns. But again, you kind of feel like these really pessimistic takes aren't really warranted. Does the market valuation today worry you at all? That seems like a less black swan event type kind of thing. That seems like within the bounds of normal.
Right. Yeah. And so to say, I think you can say, as a rule right now, you can categorically say that stock markets are valued quite highly. And when we say that, when we look at how much money the companies in the stock markets are making, and then we look at that as a multiple of that amount of how much we're paying for them in the stock price, it's pretty high. And if you are like a super financial geek and you look up terms like CAPE ratio, you're going to see that we're paying a pretty penny for those companies right now. And there's some good reasons for that. We've got these companies like NVIDIA and Microsoft and, NVIDIA is, I think most people understand, the company of NVIDIA is worth more than the entire Canadian stock market, depending on the day. That company has incredible profit margins at revenues that we've just never seen. So to some degree, I would argue those multiples are probably warranted. Now, should you be nervous about it? I think for me, I'm nervous enough to not buy into Bill Bengen's recent, statements that we can up it to 5%. Or I know some people have all these different ideas about how we can get to 6% safe withdrawal rate. I wouldn't go that far, personally. I do think there's a writer named Karsten Jeske in the USA who writes at Early Retirement Now. And he's come out with some very interesting back testing on using valuations to adjust your safe withdrawal rate going forward. But again, we always have to remember that the 4% rule, it held up in the year 2000. It held up, through all these various events. And so I would argue, our valuation's a little bit high. Yes. Our tariffs a little bit scary. Sure. Are they more scary than the Cuban Missile Crisis, where we had nuclear bombs on the doorstep pointed at North America? Probably not. Are they, more scary than the 2008 financial crisis, where we saw banks actually going bankrupt? I would say we're not really in that. Not only are we not in that ballpark, but we've actually learned some lessons about how to shepherd an economy. I'm not saying we've got it all figured out, but I'm saying, our study of economics has improved a little bit in how to put in proper safety controls. So I would argue it takes some of the worst case scenarios a little bit off the table, and I would argue the 4% rule is still pretty darn safe today.
Well, you mentioned 5% rule. William Bengen, the researcher that coined 4% rule, he recently updated his data and said, 5% is the new 4%. He felt that there was a higher safe withdrawal rate that you could sustain now, just given access to other types of global investments and the ease at which you can access those things, as well as sort of just updating the data itself for more recent time here. What are your thoughts on 5% rule? What I find really interesting, Kyle, is that you don't pursue the 5% rule yourself. So why are you sticking with 4% and not 5%?
Yeah, I think 5%, it's, it's funny because you just outlined exactly why I stay with 4%, Rob. We've got 5% over here, and then, some pretty smart people on the other side saying 2.7%. And I find each of their arguments to be fairly persuasive in certain ways and lacking in others. And so basically, I come back to 4% is pretty darn safe, especially if we're discussing a 30-year retirement. So in other words, if you're 65 today in Canada, a 30-year retirement is, I think, a pretty good planning mindset. Now, if you go up to 5%, we start to see some failure rates. And by failure, I mean we start to run out of money before the end of retirement. Before we run out, if you want to just say that. And now that is I guess, a failure rate in terms of withdrawing the amount of money you want to withdraw. But I think it's important to understand in Canada that you're still going to have some sort of a pension there, even if it's just your guaranteed income supplement that you're getting from the Canadian government. So it's not as if most Canadians will be out on the street in that situation. Your healthcare will still be largely paid for, and obviously there's some nuance in those statements I just made. But all that to say that, the worst case scenario, I don't necessarily think it's quite as bad as some people might have in their nightmares, but it's bad enough for me that I want to stick with 4%. And specifically in my case, you mentioned, Rob, when you're planning I don't use the word retirement scenario in reference to myself, just because we are still earning an income, so it's not really fair to say retired. But if you are looking at an early retirement of whether it's 40, 45, 50, 55, you might be looking at 40, 50-year retirement. I would rather err on the safe side, because those initial Bill Bengen numbers were looked at over a 30-year time frame. And so just to be safe, I would not go with the 5% rule. Now, if you make it through those first 5-10 years of retirement, historically, you're quite likely to look down one day. You've been increasing your amount by inflation each year, 4% of that initial amount you started with, going up with inflation. You're going to look down one day, on average, most of the time, and realize, oh man, the amount I took out this year, it's only like 2.5%, 3% of my overall portfolio. And I would say at that point, then you can spend a little bit more. You can probably go up a certain percent till you get to that 3.5, 3.7, 4% rate, as if you were going to retire again the next day. I think you can do that and adjust from there. But it's those first 5 to 10 years, like if you get hit with a 40, 50% downturn, if you're in an all stock portfolio and you get hit with a 40 to 50% downturn in your first 2 years of retirement, that 5% is not going to last. It's just a mathematical certainty almost.
Yeah, I think the other thing people need to keep in mind here is, like, to your point, there are some government safeguards in place here, your CPP, your OAS, your GIS, and stuff like that, that a lot of times I find retirees don't really factor in when they're using something like the 4% rule, and the 4% rule itself doesn't factor it in. So something to keep in mind, that there is a little bit more support than you might realize. And then the other point I thought that you made that was really interesting too is that, you can't adjust your spending, right? I think people look at something like the 4% rule and it's like, okay, I'm locked in for the next 30 years or doing this, but that's not the way humans behave, right? Like people change their mind. And on that note, I'm kind of curious, Kyle, what would get you to change your mind and your approach versus 4% or 5% or some other percentage? What would you need to see to change your mind?
Well, what would be really interesting, Rob, is if we had a really bad run in the stock market. So in other words, I rather than get into CAPE ratios and stuff, what I tell people, the layman's rule I use is, the more awful that the news is, the probably higher safe withdrawal rate you could actually get. Now, the issue is most people tend to retire at the end of bull markets, because what happens is we see our portfolios the last 3 years have been a great run. You could argue that since 2010, the stock market's been on an incredible run in both Canada and the USA. If you had a world diversified portfolio, it's been on a pretty great run, whether it's a 60-40, whether it's 100% stocks. And so you're more likely, obviously, to hit that number at the end of a great bull run, and you've got this, impressive number in your brokerage account, and then feel confident in retiring. It would actually make me more confident if I were to hit that number at the end of a bad run, and we had, numerous bad years, and we had all the valuation metrics were down. That would actually make me more confident. I think the other thing that would make me confident that does make me more confident is that you have the ability to go back to work. Now, a lot of 65, 70, 75-year-olds don't have that ability or are very strongly against it for various reasons. And that's totally acceptable. You just have to plan for it, obviously. But if you have the ability to work 10 hours a week, that's a really nice safety net. If you have the ability to cut expenses, like I know some folks who they decide to travel, whether it's snowbird or whether it's actually picking up their residency and moving. Your dollar can stretch a lot more in a place like Portugal, Thailand, Malaysia, Mexico. These are all places people go, and they can cut their spending quite a lot, especially in early retirement. And of course, as a Canadian citizen, you can always come back to Canada. So these are all different strategies that some people will use to kind of hedge against that worst case scenario where we could see like another Great Depression level event, I guess.
Mm-hmm. Okay, really fascinating stuff here, Kyle. We got a lot more to get to here, but before we continue, just a reminder to our viewers here to follow TD Direct Investing on social media. We're on YouTube, we're on Instagram, we're on Facebook. You can get all kinds of sneak peeks at upcoming episodes of our live shows, plus a ton of other content designed to help build your investing knowledge. And speaking of fresh content, by the way, make sure to check out the latest episode of the Money Talk podcast. Kim Parlee is going to speak with the co-authors of the book, The Upside of Uncertainty, and here's a little bit of what they have to say.
That woman who said, I eat uncertainty for breakfast, no, she doesn't. She eats granola because she carries that with her as a little island of certainty to balance out the uncertainty elsewhere in her life.
We don't know how to do this. Like, we're not taught how to deal with uncertainty.
I think it's probably the most important capability one could develop for our modern era.
Like a light switch, it's a mindset shift of just seeing possibility instead of the fearful, only the unknown.
Fascinating conversation. Make sure you check out the full thing. It's on Spotify. It's on Apple Podcasts. Check it out. It's a good listen. Okay, Kyle, back to the topic du jour here. I want to talk to you about some of the ways that retirees can help boost their safe withdrawal rate, maybe stretch their nest egg a little bit further here. And one of the things that I know that you've studied a little bit here is how to boost safe withdrawal rates and some of the safety nets that you can put in. What do you think are some of like your top tips, if you will, to help somebody do that?
Yeah, I think a couple of the top tips that I would look at are actually deferring your OAS and CPP. And just to be clear, oftentimes we'd be looking at the 4% rule as like a totally separate look from your OAS and CPP. Like if you're retiring at 65 in sort of a traditional manner, you can figure out obviously your CPP and OAS, and then separately your portfolio withdrawals sort of on top of that. If you're retiring prior to 65 or you decide to defer, then obviously you have to work in a larger amount of earlier withdrawals to fund your day-to-day spending while you're deferring that pension. But I do think it's an excellent tool, and we can dive more into that if you'd like, Rob. But just to quickly go over some other things, I think it's very key to understand if you're going to pay 1% in fees on your investment portfolio all the way through retirement, then the 4% rule doesn't work. You've got a 3% rule now. There's some interesting math in that. Maybe it's 3.2, somewhere in there. But basically, cutting fees is one of the quickest and easiest wins in investing, and we now have the tools to do so, obviously. Additionally, you can do some mathematically interesting things in terms of addressing that sequence of returns risk. Now, a lot of people over the years have said, as you get closer to retirement, you should be taking less risk. There's various your age in bonds, different rules of thumb that people have used over the years. But if we actually look at the data, the really interesting thing is that if you want the mathematically optimal approach to retirement, you should actually start with 50, 60% in stocks and go up from there, which I believe it was Wade Pfau in the US popularized this term. I'm not sure who invented it, but the glide path, so to speak, an equity bond glide path. And what that does is it's kind of a nerdy way of making it slightly less likely that you'll go broke in retirement. Basically, you're going to avoid the most scary first years by sitting in more bonds and fixed income products, and then ramping up as you get past that scary point. Now, that's getting into the weeds a little bit. I don't think it's essential for everyone to know that, but it is mathematically, a proven reality. The final one is to really understand how taxes work and understand how tax splitting can work if you're fortunate enough to be married in retirement. Couples have a lot of options as far as balancing out incomes and getting into those lower tax brackets. And of course, once you start talking about tax brackets, you get to start optimizing your non-registered portfolio withdrawals, your RSP withdrawals, your TFSA, and understanding how those will be taxed or not taxed, and then optimizing from there, holding certain investments in certain portfolios.
Okay, that's a great list of tips for us to consider here. I want to pick on that glide path when you're talking about, because that like totally turns the traditional wisdom on its head here. Like typically it's like, hey, I want to reduce my stock exposure through retirement so I'm more safe. And this is saying, no, take the opposite approach. Can you just unpack the rationale behind that a little bit and maybe give us a sense of like what type of investor would you have to be comfortable with something like that?
Yeah, I think you maybe hit on the behavioral aspect there perfectly, Rob, because it is traditionally seen as, and I would argue it can be, a risky approach in that if you end up 100% in stocks, which mathematically over the long term is considered the soundest approach to building wealth, if you will, you have to be prepared to see 40-50% in a worst case scenario. You look at 2008, you get 2 or 3 very awful years in a row. You need to be able to see your nest egg go down 40 to 50% and not panic. So that's if you want to end up anywhere close to 100% stocks, you mentally have to be prepared for that and have to understand how stock market valuations work. And I think it really helps understand like what the stock market actually is. Like a lot of people, I think, just kind of see it as a raw number, but it actually is what you're paying for companies. And so I think if you understand how corporate profits work, and kind of what buying a stock actually means or buying an index of stocks actually means, I think that helps. It helps the logical part of your brain to sort of win over that emotional part. But obviously emotions and behavior are paramount to us as human beings. And we know that a lot of us are going to do exactly the opposite of buy low and sell high, especially if we're dealing with our nest egg once we've retired and we no longer have that income coming in. We panic, right? If you had $1 million portfolio and you now have 500,000, you don't care what historical data says.
No, you're freaking out.
That hurt.
You're freaking out.
Yeah, exactly. You're freaking out. Now, again, I just went over, the folks who retired in 2000, they might have been freaking out the first 10 years of their retirement, and probably a lot of them were, but they've ended up just fine. Now, that's easy to say. Now, when you're looking at a glide path, as I stated, when you look at the math of taking money out of a portfolio as it's going up and down in value, the most risky part is right at the beginning, because obviously losing 30% in year one stings a lot more than, I'm in year 20 and my 1 million portfolio is now 1.5 million and I'm through the first however many years of retirement. If I lose, 500,000 off my 1.5 million portfolio that year, obviously, it's not a lot of fun. It's still going to suck, but it's probably not going to really affect your day-to-day life that much, I would argue, especially because you're used to spending like a fairly consistent amount of money. We look at retirement spending patterns. Most people are spending less and less as they evolve throughout retirement to the last, 1 to 2 years. And so really all that risk is at the beginning, and that's what that glide path seeks to address, is actually take less risk on day one of retirement, and then you can up the risk as you proceed through and give yourself a better chance of enjoying some really good stock market years.
Do you think that's the way to go for retirees if they can wrap their head around like the risk and the volatility of their portfolio?
I think that it's like it's if you're using the 80-20 rule, it's definitely the cherry on top. It's not the easiest thing to address because obviously as you're managing your own investments, you have to understand a little bit more math at that point, and you have to overlay it on top of like RSP withdrawals versus deferring your CPP and OAS. So it's probably not the first strategy I would recommend, but if you're watching a webinar like this and you're used to handling your own money, I think it is worth further research into the glide path and maybe some variable rate strategies. But it probably wouldn't be the first thing I would recommend to a lot of the people that I interact with.
Okay, so something for people to consider, but you got to know what you're getting into here. You spoke a little bit too there about tax efficiency, and this is a big one for retirees, of course. I'm wondering, and again, we're speaking in general terms here, but is there, generally speaking, a rule of thumb in terms of the order of withdrawals that you should prioritize for each account? Like, is it this account first, then this one, then that one? Is there any rule of thumb that you have like that?
Yeah, and again, all personal finance is personal, so
Sure.
we'll put out that proviso. But yeah, basically, non-registered accounts, generally speaking, are withdrawn first. Now, depending on your specific tax situation, let's be honest, most Canadians, we can get the majority of our investing done in our RSP and TFSA. Not too many of us are fortunate enough to have maxed those out completely and now be into a non-registered account. Usually you go RSP before TFSA. In an optimal approach, and maybe you want to talk about this more, Rob, is spending down some of that RSP in years 60 to 65, maybe to 70, and then deferring, using that extra bit of your own portfolio, and deferring your CPP and OAS until a little bit later in the game. And that lets you take out more of that RSP money, which is fully taxable, just as if you'd earned it at a job or in interest or what have you. It lets you draw some of that down while you have a very low taxable income. Of course, the flip side of that is there's a bit of a trade-off there, right? You're trading off some of your nest egg for the security of future government benefits. But if you and or your partner pass away, then the benefit that you sacrificed for on the front end, you're not going to get it on the back end. And that is a trade-off, but I think it's a trade-off that not enough people sort of consider. So that's a kind of a roundabout way of looking at tax efficiency. If you're a more affluent retiree, obviously you want to be aware of the OAS clawback. And I do think if there's one part of government benefits that's going to get looked at going forward in regards to CPP and OAS, it is that OAS clawback number. I think there's a pretty solid justification for looking at starting that clawback a little bit lower on income. And but keeping in mind, you do get to income split a lot between yourself and your partner if you're married. And so if both of you are earning up to that clawback line, I would argue that's considered a pretty darn affluent Canadian retirement. Maybe there's some folks out there that would disagree with me who are paying for life in Toronto as opposed to life in the prairies in Canada.
Sure, yeah, but I mean, it's kind of like a good problem to have if you're encountering that kind of situation with the OAS clawback. Okay, Kyle, that was fantastic. Really appreciate all the practical tips that you shared here. Our Q&A is coming up in just a moment, so to our viewers, make sure you get your questions before that. But before we get to that, I want to bring in our colleague here, Caitlin Cormier, and she's going to show us some of the tools that retirees can use in WebBroker to help them estimate their income and plan for their safe withdrawals throughout their retirement. Caitlin, welcome to the program. Great to have you.
Thanks, Rob. Happy to be here, of course.
Of course, and show us this tool that we have in WebBroker here. Let's say you want to get a sense of the income that your portfolio is going to generate. What can you do in WebBroker to help with that?
Yeah, absolutely. I mean, income generation is huge, whether you're talking about dividends or interest income. It's something that you definitely want to have at least a bit of a perspective about what's coming up. So let's hop into the platform and look at our projected income tool. So under accounts, we're going to go all the way down to the second last option in the list here where we see projected income. And this tool is going to give you a visual representation of your portfolio and what you can expect over the next 12 months for income. So this is taking all of the securities within your current portfolio. It's looking at what the projection for the next 12 months of income is based on the information that's known. And it's showing you when those payments might come, how much those payments might be, and what months they're going to be showing up in. So if you look here at this portfolio, we have July, we can see there's a payment again in August and October. If we look over on the far right, it's showing us our 12-month projection. And then when we scroll down below, we can see each month based on individual securities when we can expect those payments. So the one key thing to keep in mind that this is a projection. So it is assuming that you keep the securities the same as what they are now. And of course, not taking into consideration, any future increases in the number of securities or increases in dividends or anything like that. But it's sort of a quick and easy way to see what you can expect as far as distributions in a particular account over a period of time.
Yeah, I got to admit, I love that feature. I'm not anywhere near retirement, but I just love seeing the bars go higher and higher as I continue to invest over time. It gets me all giddy here.
Yeah.
Kyle and I were talking about asset allocation strategies throughout retirement. I'm wondering, what are some of the tools that WebBroker has to help figure out asset allocation throughout your retirement?
Yeah, asset allocation, definitely a key part, whether it's making changes or rebalancing your diversification, whatever it looks like, asset allocation is definitely a key portion. So let's look at what there is available. And you may have noticed when I first was on this screen, we do have a quick tool that you can see actually on most of your account screens within WebBroker, this top piece, where again, it shows that visual kind of pie or chart here where it shows how much of your portfolio is invested in different areas of the market. So for example, with this portfolio, we can see there's some in Canadian equities and then some in cash and cash equivalents. We can go deeper than that though. As I say, this is available sort of throughout your account pages. But if I actually click on allocation, the tool there, it will actually break down for me not just where my investments fall, but which specific investments fall under each category. So as I kind of open up the Canadian equities, it's showing me which securities are represented there, the percentage in each. And also it shows me too that I do have some investments that are in more than one class. So I could have, for example, some equities and bonds in one, ETF or mutual fund, and it'll actually break it down within that. So again, this is on a per account basis, but another way to sort of see, be able to really keep an eye on what your portfolio looks like and help you with any sort of adjustments that you need to make. As I said, whether it's rebalancing on a regular basis or if it's making some big changes to what your asset allocation looks like.
Totally, a fantastic tool. Also really helpful too as you sort of draw down your portfolio and knowing which bucket can I pull from and still kind of maintain whatever asset allocation I want here. Great stuff, Caitlin. Appreciate you showing us the ropes here. That's our senior client education instructor, Caitlin Cormier. Thanks for that. Okay, Kyle, we're going to open the floor now. We're going to take questions from our viewers in our live Q&A segment here. Are you ready to hear what our audience wants to know more about?
Yeah, throw them at me.
All right, here. I believe Jason is first up here. Let's see what Jason wants to ask here. Jason's saying, look, I'm 40, I've got no debt or dependents, single guy, and I have about $400,000 invested in index funds. Is geo-arbitrage and a career pivot still a meaningful way to extend my runway towards like a semi-financial independence, retire early situation, or is it too late for the switch to be worth it?
Yeah, I think, Jason, the switch is worth it at any age if that's what you want to do. I mean, so to those who aren't aware, geo-arbitrage is referring to like moving to a cheaper place to live. And it's interesting, I mentioned like Portugal, Thailand, some people would toss like Greece in that. There's also places just in Canada that are just a lot cheaper to live that some people might use as geo arbitrage. So just to kind of explain what that term means. And yeah, at 40, I think it's totally worth it. You mentioned, you don't have immediate family connections that would obviously be impacted by a geo arbitrage move. If you are able to work online or find some local work, I know some folks who've semi-retired or what they call like lean fire, where they're kind of just earning money for the cherry on top stuff, and they do the bartending thing. They do, English speaking baristas can actually make a little bit of money in some of these places. So if that's the lifestyle you want, I would argue it's definitely still worth it. Your $400,000 is going to go a lot further. Or if you're able to keep working full time, you're going to save a lot more in some of these areas. If you pick up your residency and move somewhere, now we're talking a different ballgame too in terms of looking at how dividends and capital gains are taxed in certain areas, and that's getting pretty far into the weeds. But it's worth looking into if you're considering doing something like that. Christy and Bryce of Millennial Revolution, if you want to check out their website, they've done a lot of geo-arbitrage work and have discussed a lot of these things in depth as well. I would highlight Andrew Hallam, who's written The Expat Millionaire, as well as his new book, Balance. I would say those are sort of required reading.
Yeah, shameless plug, we have had Andrew on the program in the past, and a little sneak preview here for our October Investor Education Month. Christy and Bryce are going to be joining us as well, so make sure to tune into that, folks, here. Kyle, listen, you're a worldly traveler here. Tell me, underrated geo-arbitrage location, go.
Wow, an underrated one that I've personally been to. Okay, I'm going to throw two at you off the top of my head. One is actually going to be either Japan or South Korea. And those aren't commonly talked about, but if you can get past the language barrier, there is unbelievably cheap deals in rural parts of both countries just due to demographics. And I'm biased because I love both countries. The people are just outstanding individuals. They're very respectful. The infrastructure is elite. Now, it's not easy to learn Japanese or Korean. I'm not saying you have to, but those are interesting locations. I would argue too, Portugal is getting more and more expensive, but one part of Portugal, and it's relatively close to Canada, is the Azores Islands. And I apologize to the folks from there that I'm mispronouncing. My Portuguese is even rustier than my Korean and Japanese maybe. But those islands are actually super affordable compared to Lisbon or Porto. And if you're relying on withdrawals from a portfolio, now that's been changing in Portugal the last few years, but there's still some interesting tax ramifications. It is probably going to be more tax efficient for you. And then you get EU residency from that, which obviously has benefits as far as being able to travel if you want to see Switzerland, if you want to see Spain, et cetera, et cetera.
All right, very cool recommendations. I have been to the islands as well. One of the few people that I know that have done it, and I wholeheartedly agree. Wonderful place, wonderful people. Highly recommend it. You got to scroll pretty deep into Google Maps to find them in the middle of the Atlantic there, but definitely a little hidden gem there for folks. We have another question here coming to us from MG, and MG is wondering, my fixed income covers 3/4 of my living expenses with an overall fixed income rate of about 5.7% here. Given my situation, could my safe withdrawal rate reasonably be closer to 5%?
I mean, again, MG, not knowing your entire personal finance profile, I can't say unreservedly that, like, yes, you're good spending 5%. I would argue you should probably, you're well on your way to looking at it this way already, obviously, given that you've broken your situation down into these specific percentages. But I would argue that as long as you are, reasonably sure that you could live off of a smaller amount of money, then that 5% starts to be a little easier to get at. But if you look at it as the luxury aspect of your portfolio, then yeah, go ahead and do 5%. It also depends on your age. Now, I would argue if you're 70, 75, then great. 5% actually works. And again, if you look up Karsten Jeske at Early Retirement Now has a pretty interesting chart looking at age versus amount that you're withdrawing. And I would be more confident recommending it in that situation because we know spending goes down. It does not follow inflation for most people in developed countries. And it's quite consistent across developed countries that our spending goes down until the last 12 to 18 months of life, when obviously the averages get skewed a little bit by end of life healthcare needs. So the answer is probably, but without seeing everything else in your situation, I don't feel comfortable saying for sure.
Yeah, certainly. There's a lot of variables at play here that we have to keep in mind here, but appreciate the perspective nonetheless. I think we have time for one more question here. This one coming to us from Fred. Fred is asking, where the 4% rule does not work is when you have to move into a retirement residence paying, $72,000 a year with a 2.5 annual increase. After 15 years, that's over 85 grand a year. Any suggestions? That's a big ask, Kyle, but what do you got for us?
Yeah, so in that situation, again, what's not being said there is basically, are you moving from a property you already own? Because if not, I'm assuming you probably worked rental increases into your budget. Hopefully you did, because there's not too many periods of time where rent stayed the same, no matter whether it was a retirement residence or any other residence in Canada. And if you did own your own home, I'm assuming you have a substantial amount of equity built up there. The other thing is, when most people set their budget and they figure out their spending and they do their 25x to get their 4% rule, they usually have a bucket list, whether that's travel, whether it's a golf membership, whether it's seeing elite museums, whatever your thing is. You're probably not going to be doing as much of that once you enter a retirement home. Again, this is talking statistically average. I know that there are absolutely very active people that live in assisted living facilities, and the phrase retirement home can mean a lot of different things. In fact, I would argue that is one of the, if there's any researchers out here listening, I would love to see more Canadian-specific research on various types of retirement housing in Canada and how much they do cost. Because that phrase can mean a ton of different things, and the variability of government assistance in each of those facilities is also quite a difference maker across the country. So I would love to see more data on that. If there's any super smart, savvy researchers out there looking for like a thesis project or something, or maybe one of the big banks wants a project to take on. But yeah, I would argue that for most people, it's going to naturally balance itself out as your other budget items decrease in retirement. Also, the fact that OAS is going to kick up when you turn 75, that's going to help offset the cost as well. So hopefully that answers it to some degree.
Yeah, and I think if you were really concerned about that, maybe that's the case to, do something like 3.5% withdrawal or something like that, and keep it artificially lower if you want to really keep like a cash pile there down the line. All right, Kyle, listen, fantastic stuff. Appreciate you taking questions from our audience. This was a fantastic conversation. I had a lot of fun. Hope you did too. So thanks again for joining us on the program, and of course, enjoy your time back in Canada.
Well, come on anytime, Rob. Thanks for having me.
Love it, love it. And to our audience, thanks so much for tuning in. Make sure you check out next week's episode. We have another good one here. We're going to explore the risks and opportunities of a relatively new product, single stock ETFs. Okay, they can offer really high income. We're talking 30, 40, 50% plus income yields here. But is there a downside investors may not be considering, particularly during volatile markets? Well, you're going to have to watch to find out here. That's all the time we have for today's show, though. From everyone at Inside Investing, thanks for watching, and we'll see you all next time.